We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Bill Holter. He's a precious metals broker and is partnered with Jim Sinclair over at JSMineset.com. How are you today, Bill?
Good. Thanks for having me, Tom.
Great to have you back as always. So you and I have spoken before about how you watch the credit markets as they are smarter than the equity markets. So of course, in September 2019, we saw the repo rates spike. So when you look forward into 2022, do you see any similar risks, or is the next big risk, the most likely one, the risk to the markets reacting to tapering and possible raising of rates here?
Actually, we're 180 degrees reversed from back in 2019. 2019, there was not enough liquidity in the system, and that's why the Fed was having to pump $100 billion a night into the repo markets. At this point, now they're doing reverse repos, and that's peaked out at, I think the last I saw was $1.6 or $1.7 trillion is being parked by institutions because they have no place where they feel comfortable as far as counterparty risk. Mm-hmm. So they're able to sleep at night with their funds being held basically at the Fed, and they get 5 basis points on an annualized basis. At least it's a positive return. And the reason the Fed's doing this is because they can't allow interest rates to go negative. Had they not done the reverse repo operation, rates would be negative right now. And that would be proof positive of really the clown show that the Fed is running.
Mm-hmm. So when we think about negative interest rates, why can the rest of the world get away with negative rates, but the U.S. can't, Bill?
Well, because we're the reserve currency. You cannot have the reserve currency of the world, for lack of better words, pulling their pants down and showing the world that the currency is worthless. Mm-hmm. Because if you have a currency that carries a negative interest rate, if you think it through, what that means is the currency is worthless because you cannot lend it and get paid. In order to lend it, you have to pay.
Hmm. And that, of course, isn't a real rate of return, but that's just the nominal rate of return, right?
Right, exactly. I'm talking strictly nominal. I mean, as far as real interest rates, they're as negative as I think they've ever been, going back to, they might have been more negative in 1981, 82. Mm-hmm. But other than that, this is as negative as they've ever been.
So I read a story on JSMineset about how JP Morgan owns $3.3 trillion worth of stock derivatives. So can you explain to those that might not be familiar what the risk is there and how that's a change through the regulations that we saw after the great financial crisis?
Well, the risk is that it's so highly concentrated. It's concentrated in one bank. And I'm not going to get into why they're holding that many derivatives. I mean, are they manipulating? Are they supporting markets? Are they suppressing markets? What are they doing? The key is that the concentration is within one bank. So if you were to wake up tomorrow morning and find out JP Morgan has a financial problem, that's 3.3 trillion counterparty risk that the market is assuming with one bank.
Yeah, and like I've heard you say before, that risk still exists and you can only just move it around, right?
Correct. I mean, that's the whole thing with derivatives. People run around saying that XYZ company is hedged, so there can never be a problem. But when you hedge something, you're placing the risk on another entity, and that entity has to perform in order for your hedge to perform. And if that other entity, the counterparty, does not perform, then you failed. Mm-hmm. And that's where we are system-wide. Is when I say system-wide, I should say just globally, everything is a promise today. Everything today, and I've said this before, the world completely runs on credit, and credit is a promise. And the problem being credit has gotten so large that once there's a failure, and we may be seeing that begin with the Chinese real estate market. It's very possible that it's already begun. Mm-hmm. But once you get a failure, two failures, three failures, they will domino, because when a company fails, either doesn't pay their debt or can't perform on the derivative, they're not doing business with just one other company. They're doing business with 100 companies or 1,000 or 10,000. It's like throwing a pebble into a pond and you can watch the ripples.
Yeah, waking up to another one of your counterparties not being able to fulfill their liabilities to you, that's where the dominoes really start to fall, right?
Right, because now the risk is no longer with them. The risk is back in your lap. And can you perform? Mm-hmm. And that's exactly where we're headed.
So, Bill, when we think about the course that the Fed has set out for tapering and then the rate hikes that they have also laid out, do you think that the taper tantrum that everybody expects coming, because everybody is expecting it, that is not likely what is going to mark the next downturn in the markets?
I think you're already starting to see the taper tantrum, if you will. I mean, just this morning, you saw the 10-year Treasury trade to 175, I think, mm-hmm. which is up, 30 basis points over the last 2 weeks, 3 weeks. I think we were at 1.4 or 139 just a couple weeks ago. So, 30, 40 basis points is not a big deal, but 30, 40 basis points from a base of 1.3 or 1.4%, that's a pretty big jump. Mm-hmm. So, in my opinion, I don't think the Fed really can taper. I'm going to go on record and say if they really, truly begin to taper, within a few weeks' time, you will see QE5 or whatever they're going to call it. Mm-hmm. Because they have to inflate or they die. Mm-hmm. They cannot let air out of the balloon in any sector.
Would truly meaningfully tapering also mean removing the reverse repo program?
They wouldn't remove it, but if they were tapering, you would see that draw down over time. Mm-hmm. It may draw down very quickly. It's hard to say, but I can't see any way that the Fed would say all of a sudden, no, we're not, we're just closing down the reverse repo operation. Mm-hmm. I don't think that would ever happen.
So, Bill, you kind of mentioned that you think that the Fed is going to reverse course. How quickly do you think that they do reverse course once we see some trouble with the markets? Do you think we are going to ever get to a rate hike as small as it might be?
Yeah, I think we probably will have a rate hike. Mm-hmm. Maybe that's wrong. Maybe we don't even get one rate hike. But I don't see 2, 3, 4 rate hikes. I mean, if you saw the equity market down 10, 12, 18%, the Fed's going to have to come to the rescue, because if they don't announce another QE, then you'll have a full-fledged meltdown. This truly goes back to what Richard Russell said years and years ago about inflate or die. They have to continually inflate. They can't stop inflating, and they certainly can't withdraw liquidity from the system.
And is that one of the big differences between, the considerations around how Volcker was actually able to raise rates in the 70s to combat inflation versus today is the amount of debt and credit in the system?
Yeah, the situation today, Paul Volcker could never do what he did back then. If you go back to 1980, when he began to raise interest rates and really tighten the credit markets, back then, I think the U.S. had the U.S. as a federal entity. I think we were only 30 or 35% debt to GDP. Mm-hmm. And now what are we, 125% debt to GDP? There was all sorts of collateral throughout the world. In the United States, I mean, there was real estate. There was all kinds of businesses that had the ability to borrow. So when they raised rates, all they were doing was they were hurting the credit markets on the fringe. In today's world, there's too much leverage. There's nothing left that's unencumbered. There is no ability to reinflate from a fiscal standpoint. There's no ability to go out and borrow on real estate, to borrow against businesses, et cetera, et cetera. That's the difference between today and 1980. And I mean, just look at it from a federal standpoint. What would a 1% rise in interest rates on a $30 trillion debt? That's $300 billion mm-hmm. in debt service. So while the United States kept the debt service between, call it 350 and 500 billion a year for years and years and years, going all the way back to the early 80s, the debt service was 350 to 500 billion per year. They kept piling on debt, but they kept lowering the interest rate. So that number stayed the same. Now we're to the point where interest rates can't go any lower. They're at zero for all intents and purposes, 1%, 1.5%, whatever. But the Treasury is going to have, what, a $2 trillion deficit this year? I mean, we're going to go over 30 trillion this year. And with no ability to lower interest rates any further. So that debt service number, now you're looking at 600, 700, 800 billion dollars every single year before they even open the front door January 1st.
Right. What about the argument, Bill, that some people say that that number doesn't actually matter considering they can just borrow or print that money into existence to pay off that debt?
Well, then what's it worth? If you can just print, and when you say borrow, who is the biggest buyer right now of treasuries? It's the Fed. So, I mean, that's basically outright monetization. So what you're saying is, what stops them from just printing forever and ever? Well, the bottom line is if you have an apple pie and you slice it 4 times, you got 4 good sliced pieces. If you slice it 8 times, all the pieces are half, and you slice it 16 times, all the pieces are a quarter. You dilute the currency is what will happen. And it's already happening. You're already seeing inflation. Inflation is out of the bag at this point.
So when you say that inflation is out of the bag, are there any tools to actually get a hold of it that Powell has?
No, they're completely out of tools. The only thing they can do is print. And like I said, they can't really lower interest rates because we're zero bound at this point, and you cannot have a reserve currency with a negative interest rate, because then that illustrates to anyone and everyone with any common sense whatsoever that currency is basically worthless.
Could we look at the fact that the international lenders basically going out of the treasury market, could that also be another symptom that the rest of the world is starting to wake up to that fact?
Oh, it's been that way for quite a few years now, for 4, 5, 6 years, and even longer. If you look at what was China's peak, was it back in 2014, 15, as far as treasury holdings? I mean, the Fed is taking a larger and larger percentage every year of what the Treasury is issuing. When I was a kid, back in the late 70s, early 80s in college, in business classes, the Fed was considered the lender of last resort. And in a sense, yes, they're a lender to the Treasury, but in today's world, they're truly the buyer of treasuries of last resort.
So, Bill, when we do get another significant crash here, I want to talk a little bit about the importance of getting your money out of the system. So specifically when we're thinking about, let's say, people that own mining equities, what considerations should you have towards keeping those shares safe if you hold them with a broker?
We've advised Jim started with the term GOTS, get out of the system, I believe back in 2004, 2005. Unless you are actively trading something, you want to get your certificate in hand. If your broker were to go bankrupt, how long before you get access to your funds? Let's say that there's a cyber attack, and people could roll their eyes all they want, but what did they just do 2 or 3 months ago? They just had a simulated cyber attack. And if you think back, a lot of these simulations have become hot and real pretty quickly. So in the event of a cyber attack, if you're holding your certificate or your shares with a broker, what's your paper trail showing that you have the shares? Your paper trail is the certificate itself. So, I mean, I would advise people to have their shares issued and hold them personally.
So, Bill, as a metals broker, have you felt a shift in people's attitude towards how urgently they want to exchange their dollars for metals?
Oh, absolutely. Just over the last, probably 3 months, maybe just a hair longer, I've had people call me out of the blue with significant sized orders. I mean, $250,000 or more, and say, I want to buy XYZ. I want to buy it today and I want to pay today. In other words, from my point of view, from what I'm seeing, it's almost like a mini bank run where people want to get their money out of whatever institution they're in immediately.
So do you think that this could be because people are worried about inflation, or what do you think that the cause of that shift in mindset is?
The inflation aspect of it, I think, is part of it, but certainly not even close to 50%. I think people understand that there's something really, really wrong. They don't exactly know what it is, but they've come to the realization that gold or silver cannot go bankrupt. So if they're holding gold or they're holding silver, it's out of the system, and they've gotten out of the way of the train.
So as we're thinking about inflation, Bill, does the way that the average person perceive inflation, considering that the Fed CPI numbers are almost certainly underreporting it, where does that confidence level start to deteriorate first?
People, put gas in their cars, they go to the grocery store, they got their tax bill, they got their health insurance bill. People can see with their own two eyes prices rising and rising pretty violently. So for them to hear through mainstream media reporting that the Fed says, oh, it's transitory, it's going to go away, everything's going to be fine, just give it a little time. We're now a full year or more into prices moving pretty drastically. So the average person is seeing it for themselves. And I mean, that's just one of many narratives that are failing. Another one, and I don't know whether you even want to get into it at all, but if you look at the COVID/vaccine narrative, that's failing. Mm-hmm. I mean, what was it? 6 months, 8 months, a year ago, we were told, if you get the vaccine, you're not going to be able to get COVID. You won't be able to pass it on. You won't have to wear a mask anymore. You don't have to social distance, blah, blah, blah. Well, guess what? At this point, it's a fact that you can get COVID. It's a fact that you can pass COVID on. And they've kept the mask rules up, and they've kept the social distancing rules up, and they've gone full-on tyranny in Australia, Belgium, Netherlands, Canada. I mean, you name it, they're full-on tyranny with lockdowns. So people are seeing with their own eyes. And not only that, people are seeing with their own eyes people having adverse reactions and people dying. I mean, what's the deal with all these soccer players all over the world dying after getting vaccinated? Mm-hmm. I don't remember a year in the past where that ever happened. As a matter of fact, I can't ever remember a soccer player ever falling down dead on the field.
I was also reading the other day that there's an insurance company in the US, I believe Indiana or something like that, that is reporting, a crazy rise in the number of...
It was 40%.
Okay.
Yeah, an Indiana company. But because we're at year end and these companies are reporting year end results, the numbers I've seen are anywhere between 12% and 80% for several insurance companies as far as their death claims. Mm-hmm. So what you have, and we posted something on this, what you have is actuaries who are just plain bean counters mm-hmm. that just look strictly at numbers. They don't care why, how, when, whatever. It's just they count the amount of deaths, and the amount of deaths have increased drastically. I mean, there was a story yesterday. There's a Christian school. I think they have 285 students in there. And apparently, and I can't believe a Christian school would do this, but they did mandate the vaccination for kids. And now they have 4 cases of myocarditis in the school. So that's what, 1 out of 70 students. If you and I were talking 30 years ago, 40 years ago, this thing would have been shut down within the first week or 2 weeks.
So, Bill, do you think that this failure in confidence in how the government is handling all of these things, do you think that starts to spill over into other areas like maybe the currency or how they're reporting other quote unquote facts of everyday life?
Yeah, how can it not spill over? I mean, the whole world runs on credit, and credit is based on confidence. And I've said this for 10, 12 years plus. If confidence breaks, everything breaks, mm-hmm. because everything runs on confidence. credit, however you want to look at it. But if confidence breaks, it affects everything. Mm-hmm. Think of it this way. If confidence breaks and you've been doing business with somebody for years and years, and you hear a rumor that he's doing business with a guy who's going bankrupt and it's one of his big customers, are you going to extend this guy that you've done business with for 20, 30 years? Are you going to extend him credit if you're hearing that he's doing business with someone else who's failed or is failing? Mm-hmm. It becomes a chain reaction.
Right. So when we think about, in a real crisis here, Bill, and we think about, the matter of confidence, when we have, let's say, physical gold or silver in our possession, does the fear of confiscation make sense in today's day and age? Considering how much debt there is, would that even really matter if you made gold illegal again?
If we went back 20 years ago, mm-hmm. or just over 20 years ago, before 9/11, I would have said, no, I don't see it. But from 9/11 on, how many laws are there now that 20 plus years ago you could not even imagine? I mean, there's law after mandate after mandate. They're going full on tyranny. So you're asking me, is confiscation on the table? I would think so. I would think it's even quite possible that you see in North America, you see a lot of mining properties nationalized. Now, that's not a confiscation, but it might as well be, because they're giving you an IOU for your equity position in a mine. Mm-hmm. So, yeah, I think it does make sense to make sure that you're geographically well diversified with your mines. I don't think silver will become confiscated just because there's not enough held. Mm-hmm. But it is possible that gold gets confiscated, and you're ultimate on the safety, not to say that they can't change the law, but if you look at the pre-1933 Liberties and St. Gaudens, those are considered collectibles mm-hmm. versus bullion. So, let's say you're fortunate enough to have 1,000 of those coins. Today, you can legally say, I am a coin collector. I am not hoarding bullion, because it is not considered bullion. Mm-hmm. And if you go back to 2010, when gold was $1,000 an ounce, and eagles were probably, $1,050 to $1,100, dealers were buying back MS-63 Liberties for $1,800. The premiums exploded because there was fear that Obama was going to confiscate. And of course, it didn't happen. And a year, 2 years ago, those premiums went back to the same pricing as eagles, which is extremely low.
Mm-hmm. When you say that they very likely wouldn't do the same with silver because there's not enough held, do you mean that it's just not enough dollar value held in silver privately?
There's not enough dollar value, and there's not enough, if you want to call it, above ground supply. Most silver, when it gets sold, gets used. Most gold, when it gets sold, still remains in, if you want to call it, deliverable form, whether it be coins or bars or even jewelry. But silver goes everywhere. Silver goes into medicinal purposes, high tech, solar, you name it. Silver gets used, mm-hmm. and gold gets hoarded. There's far more gold ounces above ground in deliverable form than there is silver, even though the silver is produced at 9 or 10 to 1. Mm-hmm. But it gets, like I said, it gets used as opposed to hoarded.
Right. So when we're thinking about the amount of metal available for delivery, Bill, are we seeing any anomalies in the Comex numbers in, let's say, open interest already this year?
Well, you've seen the second half of last year, the open interest has consistently dropped. And that tells me that more and more players are walking away from it. If you look at December's delivery, I think when all was said and done, I think we got up to 110 tons were stood for delivery for December. If you go back previous years, from 2017, 18, and earlier, that was about the amount of gold that was delivered for the whole year, was 100 tons. A big month would be 16 tons, 18 tons. And just for the month of December this year, it was 110. So there's more and more deliveries being made. They've gone crazy with the EFPs. And I don't even know, there's no way to really track whether those are actually delivered or not. But I think over an 18-month period of time, there was something like 7,000 or 8,000 tons supposedly exchanged for physical that were delivered out of London. I don't see any way that that could be because there's no stockpiles that big.
Yeah, it really makes you kind of scratch your head on what those numbers, what they're actually representing, and if they're just kind of going from vault to vault or balance sheet to balance sheet, right?
Right. And, I've had people on today's smashing gold and silver. I had 2 or 3 people that I didn't expect to hear from because I thought they were real strong hands. How long is this going to last? How long can they do this? And it's to the point now where if you understand that all the news is fake, if you understand that the statistics we're getting out of the government are fake, basically everything's a lie. I mean, we're living in George Orwell's 1984. And I asked each one of them, I said, if everything that you see with your own 2 eyes gets reported on and it's either a lie or completely fake, then why do you believe the numbers that are flashing on the screen telling you this is the price or the value of something? And I think it just goes back to when all is said and done, I believe people are going to count their wealth in ounces.
Yeah, and it's crazy to think that let's say the Comex gold price or silver price is accurate when you can't touch an ounce of either metal for anywhere close to that price, considering putting a premium on top of it, right?
Right. Well, I mean, what's the real price? For silver, they're trying to say on Comex it's $22. Can you buy any silver anywhere under $25? To me, the real price is the price you have to pay to get it in your hand. And I said this years ago, I could envision the day where you see Comex prices crashing. And actually, we've seen it a couple times where Comex pricing crashed. I mean, go back to 2013, Comex silver was $9 and you couldn't buy an ounce for $15. But I really believe that we will get to the point where Comex prices crash and continue to crash, yet the cost to get real metal in your hands will go up, continue higher, and get to the point where you might as well call them the periodic table symbol would be unobtainium.
So why would the Comex price at that point continue to crash if the real value of it, really becomes unobtainium? Is it because it's so tied into the financial markets and there's so many derivatives in those contracts?
What's the value of a contract that cannot perform? The answer is 0, right? So if Comex can't deliver gold or they cannot deliver silver, then what's the value of that contract?
Right.
And if anybody who's long that contract, what would be the best thing for them to do? Sell it and close the position.
Excellent, Bill. Is there anything else you'd like to add to our audience before we wrap up here?
Other than just try to do the best you can with whatever your circumstance is to prepare. I can't tell you exactly what's coming, but we're getting a taste of it. We've been getting a taste of it for several years now. And think along the lines of try to be as independent as you possibly can with your day-to-day life. And that means your ability to source food, your ability to source energy, et cetera, et cetera. Think of it as, there's going to come a time, whether it be a couple weeks, a couple months, God forbid 6 months or more, where basically you're on your own and what you have on hand is all you're going to have for a spell.
Well, hopefully it doesn't come to that, but if it does, hopefully some people have heeded your advice, Bill. Of course, your guys' website is JSMineset.com. Anywhere else you'd like to point to for people to find you, Bill?
Yeah, if you want to email me, my email address is bholter, Holter, @hotmail.com. And mentioning the website, we just put out I think the first deliveries are going out now. We put out a compendium, which is it's a complete listing of everything that we've posted, both on the free side and all of our subscription articles, all of our subscription recordings, et cetera, going all the way back to 2008. And my hope is that we live in a world where history is being rewritten on a daily basis. they're trying to whitewash history. And my hope is that some of these things turn up 25 years from now, 50 years from now, when people are asking, how in the world could they have let that happen? Mm-hmm. Because, it's a real-time commentary of what actually has been happening.
Mm-hmm. Yeah, this is going to be a very interesting point in history to be able to look back on one day to see, what some of the outcomes of the decisions that were made and how that affected the world.
Well, it's mass psychosis. Mm-hmm. Everybody has gone nuts. And if you use common sense, I'm sure half or more, probably way more than half of your listeners, they're the black sheep of the family. They're the nuts because they don't agree with what's going on and they use common sense and logic, and, their family thinks of them as the nut job of the family. I assure you, you're not.
Mm-hmm. Excellent, Bill. Thanks so much for your time today.
Thanks for having me, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.